Do more. Recently. Even for vision. Exactly. Exactly. Like stress, it's secondary. You got your favorites. Oh, yeah. I just on the air or something. That's real potential.
Morning, how are you? Good.
Yes.
Freezing this morning though.
Okay, folks, we are okay. So today we're pretty much done with the mechanics of discounted cash flow valuation, how to estimate cash flows, discount rates, growth rates, terminal value. If you notice, none of the things are particularly complicated, just the coming together of all those pieces. Today, we're going to talk about what I call the loose ends in valuation, things we do after we claim we're done. So I'm going to start today's session, the start of the class test, by focusing on some of those issues. Right? So you take your free cash flow to the firm, you discount the cost of capital, you get a value for the operating assets. Then what are we taught to do in every book? Add cash, right? So I'm going to start with a question about cash because I want to take a deeper look at cash today. And I'm going to look at something I've heard from equity research analysts, and you tell me whether you can go along with this. Lots of companies have big cash balances. 10 billion, 50 billion, 150 billion, 200 billion. And I've heard analysts say that what's the problem with cash balances is the rate of return they earn is much lower than a company's cost of capital. I thought we said that metric, right? If a company doesn't earn its cost of capital, it's destroying value. Does this statement hold? Is it true that cash is a wasting asset because it earns a return less than your cost of capital? What do you think?
If it's invested?
It's invested. I mean, let's take Apple. Apple right now makes 4% on its cash. Its cost of capital is 9%. It makes 35% of its projects. Does that make cash a wasting asset for Apple?
No,
Why not?
because it has a return of 4%.
And why is that enough?
Because the earnings that they have plus their investments with their cash is larger than their cost of capital.
Do we even need to go there? What's the cash invested in? Something liquid and riskless, right?
T-bills.
If you or I invested in something liquid or riskless, which I had to do yesterday, I had to sweep all the extra cash in my brokerage account into something so it's not sitting around idle. I bought T-bills. Why? Because you can directly auction. You don't have to go through a money market fund. You can buy the T-bills directly. You know what I earned? Roughly 4%. It's true cash earns a low rate of return, but it's a rate of return that you should earn given on something liquid and riskless. We'll talk about reasons to punish a company for holding cash, but it should never be you earn a low rate of return. If we did that, think of the damage we could do going around companies and saying, I'm going to take off 10% of your cash or 15%. So the low rate of return doesn't bother me, but the fact that you could do other things with the cash potentially could be a problem. Franz, you look like you have a question. Yeah. Take a second issue, and this I think is, to me, the biggest challenge in discounted cash flow valuation. You value a company, you take the cash flows, discount at the cost of capital, you deal with cash, and then you look around and you realize your company has cross holdings. So I want to start by testing your accounting of how cross holdings get dealt with. If you feel comfortable enough, jump in. If not, I'll fill in the gaps. Let's assume you have a company. Company A owns 60% of company B. And you're looking at company A's financial statements. So you take the revenues, earnings, exactly the way we've done free cash flow to the firm. How much of company B will be in your value? Do you see what my question is? You've taken the revenues, earnings, cash flows from company A. It owns 60%. Michael, tell me why. Accounting rules require to consolidate. I've never understood this. So I own 60%. You ask me to act like I own 100%. Do you see what this is going to create at the end, right? After I finish the valuation, I have a 40% problem. So what do I have to do? I have to clean up for that 40%. We'll talk about how many analysts do it and why it might not be complete. Let's take another exercise. Let's suppose company A owns 10% of company B. Michael, I'm going to come back to you. Now, what will I see in the financial statements?
Well, that's right on the control side. So
Anytime you're not consolidating, where does the number show up? Below the operating income line, which means when I do my free cash flow to the firm, I'm going to completely miss it, which means I have a lot of mopping up to do. You're valuing Microsoft. I don't think your OpenAI position is consolidated. That's a big chunk you're leaving on the table because it's not consolidated. So already you can see with cross holdings why this is going to be messy, right? Sometimes you overcount, sometimes you don't count it all, and you got to bring it all in. So let's say you've dealt with cash, you've dealt with cross holdings, and you take a look at the accounting balance sheet, and you get tempted. Tempted to do what? To start adding other stuff on that's on the balance sheet. So I'm going to go through a list of things, and you tell me whether if you've done a discounted cash flow valuation, you would add these items on, and if you will, tell me why. If not, tell me why not. First, the company has a headquarters building, New York City, worth hundreds of millions of dollars. Would you add on the value? So let's say valuing JP Morgan, right? 277 Park, 270 Park. I mean, you can go around the city. All those buildings, if you add them up, collectively worth more than $1 billion. Would you add on the value of the headquarters building? Is it a valuable asset? Yeah. But who's sitting in those buildings? Traders and bankers. What do? Hopefully something. But they generate the cash flows used to value. Do you see where I'm going, right? When you value the cash flows, you can't value the things that generate those cash flows as well. So I'm not going to count the headquarters building because it's already in my cash flows. What about vacant land? I don't know whether there's any vacant land, maybe in the East Village somewhere. Drug dealers have filled it. No. Would you add that on? What do you think? But as long as I have not counted it as something I'm going to build a factory on 4 years from now and have cash flows. Do you see what the test always is? Have I somehow counted the benefit? What about patents if you're a pharmaceutical company? Why not? I think you already have the pattern here, right? Whenever you look at an item, say, is it already in the cash flows? And the answer is yes. You can't eat your cake and have it too. Let's go to the easy ones. How about brand name? Accountants are increasingly putting it on accounting balance sheets, right? Why not? Diksha?
Benefits out of it, so it's already part of your cash.
Tell me where, right? Because the brand name people say, where is it? And you got to be very specific. Where is it showing up? I take Coca-Cola. Everywhere, right? Revenues, margins, even the rate at which I can borrow at. I've counted it in. You can argue maybe I can use it better, but it's already in there. Let's not even talk about goodwill. That's a non-starter. What if your CEO has gone on this binge of collecting Picassos using company money? Then maybe, right? First figuring out what he owns, and that, so if he owns a penthouse apartment on Fifth Avenue, these are, these kind of add-on assets that old companies accumulate. Technically, you could argue that they should be counted, but the question is, how will you ever get your hands on them? So the general rule is be careful about what you add on, because most of the time, it's already in your cash flows. One final point. Some of you are valuing companies that are going to be easy to value. Easy because the accounting is straightforward, you know what they do. Some of you are working with companies that are messy in many ways. The accounting is messy, the business mix is messy, they're special purpose entities. Which of the two companies, assuming the numbers look pretty similar, which of the two companies would you value more highly? The simpler company or the more complex company? Or they both have, let's say all of the numbers look exactly the same. Mitt, you want to try? Simpler company, more complex company?
I think they should be.
In fact, you open up any textbook, they should be valued the same. But go with your gut here. Would you really value this the same? Yes.
In a complex structure, like
Cash flow, mobility in a complex structure. There are so many words in there that I want to kind of take them one at a time. Cash flow, mobility in what sense?
if the cash flow in a complex structure, if the majority of the cash is sitting at, let's say, a subsidiary that's not easily accessible,
Okay.
then I think it's more difficult to. assess.
Okay, I see where you're going in terms of, can I get my hands on the cash flows? It looks like it there, like it's there. That could be part of it. What else? We'll try.
How many big pieces you are of that? So the P would be more valuable than A.
B will be more value. That's an interesting twist. So, we have one simple company, one complex company. I'll give you the reason why in valuation theory and practice, we ignore complexity. We make a very dangerous assumption. We make the assumption that what you don't know will get averaged out. That's a basis of a diversification, right? But let's step back and think about it, right? Think about complex companies. There are things you don't know. What are the things you don't know? What management has chosen not to tell you? Ask you a follow-up question. What do managers hold back on? Good news or bad news? Good news, right? The problem with the diversification argument here with complex companies, when you get surprises, they're more likely to be when was the last time you woke up to an accounting surprise that said, you know what, guys, we made 5 times more money than you thought we did, right? The surprises are one-sided. It's I'll talk about when I started thinking about this actively and how we might have to bring it into value. So already you can see lots of different strands. So let's go back to the lecture notes and start with cash. You know how academia works? If any of you have friends or acquaintances who are professors who complain about how hard their lives are, don't believe them. Right? I'll tell you how hard I work. I teach like 6 hours a week for 15 weeks. I get the remaining 37 weeks off. But because I work so hard every year, every 7th year, I get the entire year off with pay. It's called a sabbatical. It's very biblical. I work for 6 years, get the 7th year off. I'm sure you all will have similar arrangements at your work. Work 15 weeks, get 37 weeks off. My wife teaches 5th grade. She said, you have a cushy life. And I said, of course I do. So every 7th year, you get a sabbatical. And usually people have big plans for their sabbatical. So this was 2 sabbaticals ago. In academia, you measure your life in sabbatical to sabbatical. Right? So it was about 2 sabbaticals ago, sabbaticals coming up. And my plan for my sabbatical was I wanted to wake up every day with nothing to do for a whole year. The first day of my sabbatical, I was a little over the top about this. I went to an office supply store and got one of those things where you write to-do lists and I put it up. So I stayed at home, put it up above the little section of my home where I used to work. And my 4 kids were all at home then, and they were going to school. They came down to go to school, and I pointed to my to-do list. I said, I have nothing to do today, kids. Pissed them off no end, but then they left. And then I made my fatal mistake. My wife came down the stairs, and I said, Hannah, I have nothing to do today. She said, really, why don't you take the dog for a walk? I took the dog for a walk. I come back, there's an item on my to-do list. It says, pick up bok choy at the grocery store. I'll make a confession. I had no idea what bok choy was. I was too embarrassed to ask. An hour and a half at the grocery store. I finally find it's ugly looking cabbage. I come back home, another item on my to-do list, pick up kids from school. And after the fourth or the fifth item, I said, I need to find things to do to keep my wife off my list. I'm desperate. So I get an email from the editor of CFA magazine, a magazine I've never read in my life. He says, would you write an article for us? My first reaction was, I'm on a sabbatical. I want nothing to do. But then I realized I needed things to do. So I said, okay. And I'll tell you, it's the only thing I've ever written in my life that's got me hate mail. You know how difficult it is to get hate mail in finance? People don't feel strongly enough to hate you for using bottom-up betas or implied equity risk premiums. One reason I got the hate mail was the title for the piece. It said, stop the garnishing. You know what I was talking about? The practice and valuation, you tell me you're done, then you add 30% for control, knock off 25% for illiquidity, add 15%, subtract 10%. So if you're going to do this, you're going to come back to whatever number you wanted to see in the first place. And I might have used the word arbitrary to describe the premiums and discounts, which I think piss people off. So wave of insults coming, mostly from private company appraisers. But one of them, I think, got a good point. They said, if you don't like the way we're doing things in valuation, why don't you talk about how to do them better? And I said, you have a point. I have 11 months left in my sabbatical. Each month, I'm going to pick up a loose end, and I'm going to talk about how I would try to approach valuing the loose end. The first month was on cash, second month on control, third month on liquidity. So my plans to do absolutely nothing on my sabbatical fell to pieces, but it's now one half of one of my books, The Modern Valuation. The second half of the book is the residue of that sabbatical. So I'm going to take you on a speedy journey through that sabbatical year and talk about some of the loose ends. I'm going to start with cash. We already talked about reasons not to discount cash, right? Don't discount cash because it earns a low rate of return. But I'm going to argue that there might be some companies where you see a cash balance, but you discount the cash balance. And other companies where you see a cash balance and attach a premium to it. We'll talk about what might lead you to do that. Second, stop cross holdings. In a perfect world where I gave you access to all of the information you wanted, how would you value cross holdings? We'll start with that. Then we'll talk about the world we live in and the limits we have on information and why you might have to take shortcuts or approximations to deal with cross holdings. Third stop, I want to talk about what else should I be counting off a balance sheet? What exactly is an add-on asset? Because I've seen people take things off the balance sheet, add them onto a DCF valuation and double count and triple count. We'll make a stop at complexity. Should I punish companies for being complex? And then we'll talk about debt. We've already talked about debt in one context, right? When we talked about cost of capital. But now this is a different revisiting of that number. We're saying, what should I be subtracting out from the value of a firm to come up with value of equity? And I'm going to argue that maybe the rules have to get a little looser because things you've got to bring in that you worry about. What if there's a lawsuit hanging over your company's head? It might not be showing up as a liability yet because it's just brewing, but should you be factoring that in? Once you get to the value of equity, 30 years ago, when I was teaching this class, the end was near, right? You divide by the number of shares. But starting in the 1990s, what did US companies increasingly start to do in terms of compensation? Shift to options and then to restricted stock. There's a lot of cleaning up to do that. What if you have options outstanding? And I'm going to argue the way in which we deal with options and valuations is incredibly sloppy. Trying to adjust the number of shares, fully diluted, or count only the options that are in the money. So we'll talk about how to deal with management compensation in the form of options and how it affects your value per share. So lots on the agenda. Let's start with the value of cash. The rule is very simple, right? And this is there for a reason. Don't mess with cash. Cash is cash. So 100 million cash is worth 100 million. And at least in firm valuations, you keep it apart till the last moment, right? You value the free cash flow, discounted the cost of capital, you bring it in at the last moment. In equity valuation, it's actually unclear where it shows up. You do a dividend discount model. Where does the cash show up? Maybe it's being used to pay the dividends, but it's kind of implicit. Free cash flow equity models, where you start with net income without adjusting for interest income. Basically, you leave it in there. Cash is somewhere in there, you have no idea where. So cash can be very sloppy in the way we deal with it. So I'm going to start with a very simple structure so we can see why cash in the hands of different companies might be valued differently. Say I have three companies. They have same enterprise value. They have same cash balance. And these cash balances, no doubt that there is, so this is not Satyam Computer Cash. You've heard of that story? The Indian company that was a technology company, where the auditors would go in and they'd say, we have 200 million in cash, and say, where is the cash? And the company said, well, it's up there somewhere. It's in cyberspace. And they were a technology company. Auditor said, okay, that must be true. Turned out they had no cash. So there's no doubt about this cash. There's 100 million each of the companies. But here's where they're different. Company A has had a history of earning a return on capital roughly equal to its cost of capital. Company B has had a history of earning a return on capital that's less than the cost of capital. All I can show you is the history, right? I don't know what they will do in the future. Company C has had a history of earning 10% more than its cost of capital. The first two companies are developed market companies. The third company I've put into Argentina. There's a reason I'm going to bring that. I'm going to argue that in one of these three companies, cash will be a neutral asset. In other words, it'll be valued at exactly 100 million. So let's make a pause right there. Which of these three companies is cash most likely to be a neutral asset and why? Other? Company A. And what is it about company that makes it a neutral asset? It's a blah company. What do blah companies do? They don't hurt you. They don't help you. They run in place. Before you complain about a company being a blah company, let's turn to the second one. Which of these three companies is cash most likely to be a wasting asset? And why? Yes.
See?
Is it the Argentina that throws you off? What is it about company C that bothers you?
Well, returns, if its return on invested capital is higher than its cost of capital, should be putting that cash to work.
That's a different question. They could be worth even more, but at least they have good projects, right?
Yeah.
So with company C, I might say, look, why don't you invest more? And we can talk about why they might not. But their history suggests they have good projects. Do you see why company B terrifies you or should terrify you? What does the company have a history of? Stupidity, right? You give stupid management a lot of cash. What do? Even more stupid things. This might sound over the top, but if you have a history of taking bad investments, doing terrible acquisitions, and I see a cash balance, I start discounting it for the things you might do with the cash. It's not cash itself that's a problem. It's what I think you might do with the cash. Company B is most likely to be the one where you discount the cash. With company C, we'll talk about why the Argentina might make a difference, but I did regret putting in Argentina because I did the same session in Brazil a few years ago. To a person, every person in the audience picked the third company. I said, why? So you can't trust these Argentines. Maybe they'd lost a soccer game the previous week or something. There was something happening under the surface. But the reason I put in Argentina is I'll go back to corporate finance 101, the utopian world. No company needs a cash balance in that world. You know why? Because you have a great project. What do I assume you can do? Go out and raise the money. Capital markets are always open and accessible. So you don't need a cash balance. Now, do you see why I picked Argentina as my country of origin? In this century alone, Argentina as a country has seen its entire capital market shut down at least 5 times. When I say shut down, you can't raise equity, you can't borrow money, you have no access to capital. Do you see the advantage of having a cash balance in a market where capital can shut down? You can survive the next downturn. You might even be able to buy assets at pennies on the dollar because you have cash. Cash might actually have a premium, not just because a company earns more than its cost of capital. Apple earns more than its cost of capital. I'm not putting a premium on the 200 billion cash because they can raise capital if they wanted to. It's because they have limited access to capital. That's why when you see a small tech company with a big cash balance, before you jump down their throat, it might actually be a sensible thing to do for them because they can survive and deliver the growth value that you think they're worth, rather than failing because they run out of cash. Other?
For company B, if it's a young growth company, it might not have
Yeah, that's different, right? So if it's a young growth company, you might cut it some slack. That's true, right? So any questions on that? So the key issue then with cash is not the cash itself, is whether you can trust management of the cash. You remember in corporate finance, in the dividend policy section, I talked about trust and how when you trust management, you're willing to let them hold the cash. And that trust comes from looking at a history. If a history of doing bad acquisitions or taking terrible investments, you lose that trust. So the right reason for discounting cash is because you don't trust management. The wrong reason is cash earns a low rate of return. That's kind of a non-starter. Any questions on cash balances? So cash is an easy asset to value, but you can even see, even with cash, you might discount the cash. There's a set of companies whose entire asset base is easy to value, attach a number to, called closed-end mutual funds. Mutual funds typically are open-end mutual funds. So if you send your money to T. Rowe Price or Fidelity Magellan, what happens, the money comes in, the number of units increases, your net asset value is basically the total market value of the fund divided by the number of shares. In a closed-end mutual fund, you actually have a publicly traded company whose only assets are other publicly traded companies. They buy Apple and Washington Post and whatever else, and you buy shares in the company. You're saying this should be the easiest of all companies to value, right? The shares in the company should be whatever the value of the holdings is divided by the number of shares. It's one of the, in corporate finance, oh, one more thing before I leave the cash. This is actually a study from about 25 years ago, which looked at how much $1 in cash is valued in the hands of different companies. So it broke the entire US market down, a study of just US companies. And it was a very clever study. It tried to actually isolate the cash balance of what is the market attaching as a value to the cash. I'll give you the good news. Across all US companies, $1 in cash is valued at $1. Why is that good news? Because that's what we do in every valuation. But if you break companies down into mature companies earning less than the cost of capital, companies like Company B, $1 in cash is valued at 69 cents. That's an astonishing discount if you think about it. You have a $10 billion cash balance. I act as if you have only 6.9 billion. And if you look at the other extreme, at smaller high growth firms, which earn well above the cost of capital, $1 in cash is actually valued at $1.22. The market seems to be okay, not just okay, giving you a premium because you hold on to cash. The first group, the mature companies which earn less than the cost of capital, it's a bit of a puzzle, right? Let's say I'm the manager of that company, and I come to you and you're my advisor / consultant. I said, look, I'm trading at a big discount. I have this big cash balance. How do I make the discount go away? What should your advice to me be? This is very simple advice. Give the cash back. You know what? I'll fight you every step of the way. Why? Because I want to hold the cash and convince you that I've changed my ways. It's so management sees the discount, but it doesn't want to take the obvious route. Now do you see why a Carl Icahn or a Bill Ackman, this is your perfect target? Because you target the firm, all you have to do is return the cash, the discount disappears. You don't have to do any operating shifts, no leverage changes. Without activist investors, though, you can have companies hold big cash balances, have big discounts, not much is going to happen at those companies. So now let's talk about closed-end mutual funds. In almost all of the finance literature, this is called a puzzle. We'll talk about why they call it a puzzle. They looked at closed-end mutual funds. You'd expect them to trade at roughly whatever their market value of their holdings is. They consistently, at least on average, there are a few exceptions, about 85% of them trade at a discount. The median discount is about 15%. So think about it. You have $100 million in market cap stock, publicly traded stocks as your only assets. I'm pricing you at 85 million. Let's pause right there. Does this look like a way, does it look like there's a pathway for you to make arbitrage profits in the true sense of the word? You can buy the company for 85 million. Right after you liquidate the company, sell the publicly traded shares, you should get 100 million back, right? So the first puzzle was, why doesn't that happen? Why do you think that doesn't happen? You have a closed-end fund with a market cap of stocks, 100 million, it's trading at 85 million. why don't you see closed-end funds that's being bought out and liquidated? Think through what will happen. So you buy the closed-end fund. What's the first step? You have to be able to acquire the fund without pushing the price up from 85 million to 100 million, right, Michael?
Maybe if the fund was liquidated, the arbitrage would actually go away because it would suppress.
That's an extension of the first one, right? You push the price up, but you still will gain on that first section as you push the price up, right? The average price should be less than 100 million. You also, once you get to 51% of the shares, you have to be able to liquidate the fund, which means that there's got to be a board of directors that goes along. Many of these funds are often headquartered in parts of the world where you can't actually get them liquidated. And there's a third problem. When you sell the shares and you get 100 million, do you get to keep the entire 100 million? There's capital gains taxes. So there's lots of reasons they survive, but there is this enduring discount of 15%. So I want to first look at why there's a discount, because I think that our discussion of why cash might be discounted gives us an opening for why closed-end funds are discounted. Let's say you run a closed-end fund. You make about 11% return. You expect to make 11% return. But let's say, given your risk, you should be making 11.5%. You're earning 0.5% less than you should. Am I being unfair to you? Remember, the average active money manager underperformed the market by 1 to 1.5%. So I'm actually putting you in the top third of money managers. But think of what will happen now when I value your fund, right? You invest $100 in your fund, you make $11 each year. You need to make 11.5%. So if I value that fund, it's basically a perpetuity. Forget about growth. It's $11 divided by 0.115, which gives me like $96 for the fund. There's your 3% discount. You put growth on top of it, it'll become a 10% discount. If I make your returns 10.5% instead of 11.5%, the discount's going to get even worse. Do you see where I'm going with this, right? If you're a closed-end fund manager, the less I think about you as a fund manager, the bigger the discount is going to get. Now, what about the 15% of closed-end funds that are traded at a premium? What does that tell you about these funds? That you think that the managers there will beat the market, either because they're funds investing in countries where these people have inside information they can exploit, or the fund manager has this great reputation. So let's talk about the most famous closed-end fund in history. You've probably never seen it talked about as a closed-end fund. It's actually an insurance company that has every insurance company has a closed-end mutual fund inside it, right? Because why? Because insurance companies collect premiums from you and I. They invest those premiums, or at least a fund manager, in whatever they want. I've given you enough clues. Who am I talking about? Berkshire Hathaway, with Geico being the insurance front and Warren Buffett being the manager of the closed-end fund. You have the most famous and best regarded portfolio manager of all time running your closed-end fund. How is it going to show up? It's going to show up as a premium that I'm willing to pay for Berkshire Hathaway. One thing to remember, when you buy Berkshire Hathaway, you're buying all the shares that Berkshire Hathaway invests in, Coca-Cola, Washington Post, Occidental, but you're paying a 50% premium over the market price in doing so, because that's effectively what that price to book ratio is. Remember that Berkshire Hathaway is required to mark to market all its holdings. You're paying a premium on top of that. So what I have in this graph essentially is the market cap, that's a red line, the book value of common equity. For the longest time, the Berkshire Hathaway reports that Warren Buffett turned out had a market cap number and a book value number. They've stopped doing it for the last few years, which tells you something about the loss of faith, even at Berkshire Hathaway, in book value. But I've also graphed out what the price to book ratios are for Berkshire Hathaway, which is the typical insurance company. You go back to the 1993-2002, Berkshire Hathaway traded at 30% premium. You go to 2003 to 2012, about a 39% premium. That premium dropped off in the last decade, and it's now completely gone. Why? I'm sorry? That's a kind of morbid thought. I don't know whether he's going to die soon, but he's 93 years old. And he has actually officially told the world that he's not the one picking stocks. I don't know why people don't listen to him. 10 years ago, he picked Ted Wexler, and Coombs to basically two portfolio managers that he handpicked. And he said, look, I'm 83, at that point, 83 years old. I'm not going to be picking stocks. These two guys are picking stocks for you. And they're nice people, they're good portfolio, but they're not Warren Buffett. The Buffett premium has faded because he is older, the market has factored that in. Something to think about. Anytime you have a fund driven by a superstar manager, this too shall pass. And when you pay a big premium for that fund, you're effectively going to see that premium fade away. So as you look at closed-end funds, you look at cash, the question you're asking is, who's investing this money? Do I think they can earn more than the market, roughly the market, or below the market? Okay. You had a question? Yeah.
They don't invest in tech companies, so.
That's a little, they've never invested in tech companies, and we gave them a premium 30 years ago, right? So that's a different issue almost. They were able to make money, but I think the fact that you don't have a stock picker that is as highly regarded, probably never will, as Warren Buffett, is a big factor in the fading of the premium. So let's talk about cross holdings. First step in dealing with cross holdings is recognizing the accounting can be widely different. First, if you own 3%, 4%, 5% of a company and have zero role in how the company is run, you might be lucky enough to qualify what are called minority passive holdings. With minority passive holdings, here's what you have to show on your income statement. The dividends you receive from those cross holdings, dividends. And on your balance sheet, you have to show what you originally invested to get that cross holding. So I'll take you back to 1997 and talk about a company called SoftBank. It's a company still around, but in 1997, SoftBank was this young Japanese venture capital firm that had been listed, still run by Masa Son, a much younger Masa Son. And 70% of SoftBank's value came from one holding, an investment they'd made in Yahoo with a 50% venture capital investment that was now worth $7 billion. So let's play it out. It was classified as a minority passive investment. So if you went to SoftBank's income statement, what did you see from that holding? The dividends that Yahoo was paying in 1997, which were zero. You go to the balance sheet, what do you have seen? You have seen 50 million. Talk about a disconnect from reality, right? You can see how much you'd have left behind if you minority passive investments, very little information in your financials. Thank God, minority passive investments are rare. What's more common are what are called minority active holdings. So let's play it out. Let's suppose you own 20% of a company. You take some role, even a small role in how it's run. You have to use what's called the equity approach. What's the equity approach? In your income statement, below the operating income line, I want to emphasize that, you have to show 20% of the net income on net loss. So now you, rather than dividends, you have to show that in your income statement. And in your balance sheet, you have to take your original investment and add 20% of the retained earnings. It's like an updated book value. Not perfect, but still better than a minority passive investment. And then you get to a 60% holding. I told you accountants flip out. They ask you to count 100%, consolidate. Both IFRS and GAAP require consolidation. So when you do your revenues, you got to count 100% of the revenues as a subsidiary. You tell the accountant, but I own only 60%. The accountant says, don't worry about it. Get to operating income, you count 100%. You go to the balance sheet, cash 100%, debt 100%, everything at every stage you're saying, but I own only 60%. And finally, the accountant wakes up at the very end and says, but you own only 60%. He said, that's what I've been trying to tell you all this time. You don't own 40%. Duh. You got to take out the 40%. And what do accountants do to capture the 40% that doesn't belong to you? What's the item on the balance sheet? It's called non-controlling interest or minority interest. It will always be on the liability side of the balance sheet. So before you get carried away, check out the liability side. If you see a non-controlling or a minority interest, something is being consolidated somewhere. It might behoove you to figure out what it is. Maybe it's too small to care about, but that's consolidation. Now we've added joint ventures to the mix. There are cases we are allowed partial consolidation, which means you count only the 60%. Already you can see we have a lot of cross holdings and joint ventures. The first step in valuation is to figure out how they've been accounted. Otherwise, you're going to misread the balance sheet. So let's first start by talking about, in an intrinsic valuation, in a perfect world, how we would bring these cross holdings into the mix. In a perfect world, here's what I would do. First, I would value the parent company with parent company financials. This would require that your company actually have parent financials and consolidate. That's not true in big chunks of the world, but if you have both parent and consolidated financials, I'm going to value the parent company, the standalone company, without any of the cross holdings. Then I'm going to take each subsidiary, I don't care whether it's minority or majority, value the subsidiary as a standalone business with its own cash flows, growth, story, discount rate, risk. And then I'm going to take the pieces of each that you own, 5% of this, 7. So effectively, the value that I will attach to the firm will be the parent company value plus the sum of the values of all. You see the advantage of doing this? You're a chemical company with a steel subsidiary. I give the steel company a steel company cost of capital, a steel company growth rate. It allows you to take each business and value it as a standalone. But to do this, what do you have to have? You have to have access to financials for every single subsidiary, not just revenues and income, but full financials. So I'll give you an example where I had the data to do this. In 2014, I valued Yahoo. And by the time you got to 2014, Yahoo was a dying business. It had a search engine that nobody searched on and an email program that only old people used. So you valued as a standalone business. The value that you got, and I was being generous, was about 7.4 billion. So this is Yahoo, just the search engine company, 7.4 billion. But there are two cross holdings of immense value. One was 35% of Yahoo Japan, which was a standalone separate company. And for whatever reason, the Japanese still use Yahoo. And it was a much more prosperous company than Yahoo, the US version. I valued, and because it was a publicly traded company, I was able to get its financials. I attached a value of 20.21 billion to the equity, and I took 35% of that. And the second holding was its 22% holding of a company called Alibaba. Alibaba was still a private business, but it had just filed its prospectus to go public, which opened the door for me because now I had the financials for Alibaba. I could value it as a standalone company, a Chinese, I'm not even sure, it's not a Chinese retail company, but basically a Chinese advertising company because it connects buyers with sellers. And valued separately, the value that I got for their equity is 146 billion. 22% of that is 32 billion. You add the three numbers up. And just to clean up, I made sure that if I actually had to sell these holdings, I'd have to pay a tax liability. So I took that out. And I came up with an intrinsic value of Yahoo that includes all three components. Why was I able to do it? I wouldn't have been able to do this in 2013 because Alibaba was still privately held. I would not have. It was the fact that they filed a prospectus that allowed me to do it. So this is a rare case where I actually value the cross holdings. Why? Because the cross holdings had financials, and the other is the cross holdings are where the bulk of the value of this company comes from. When you're buying Yahoo, you're not buying Yahoo, the search engine. You're buying a piece of Alibaba and you're buying a piece of Yahoo Japan. And because it's so much of the value, I had to kind of fill in the details. You have to do three separate valuations. Yeah, three separate. And thank God it was only three. Can you imagine if there were 15 cross holdings, how much more work would be involved? So I'm going to talk about the real world problems you run into. The real world problem you run into is when you look for the data, it's just not there. So let's say you're consolidated, but it's a privately held business. There's no information there. Or you have holdings in other companies, they're privately held and you can't get access to the full financials. And I'll tell you a story. This was in the late 90s. I was working, I think, on the second edition of my investment valuation book. It's valuing a Japanese company. And with Japanese company in the 1990s, you're always teetering on the edge of disaster. Why? Because Japanese risk-free rates were so much lower than in the rest of the world that if you used any growth rate you were used to using in the rest of the world, your valuations blew up. So I was careful. I finish up. I'm patting myself on the back. I take a look at this company's balance sheet. They tell me they have 227 cross holdings. So Leon, what do I need to do to value this one company? Value 227 other companies, right? There is zero chance. I'm a lazy person that I'm doing this. But even if I'd wanted to, I couldn't have. 60 were public. I could have got their financials. But the other 167 were privately owned businesses with zero information provided on any of the operating details. So I called the investment relations officer of this Japanese company. I said, look, I'm valuing a company for a book I'm writing. It's not for an expose. Could you give me some information on your cross-holding? She said, I cannot. He said, why not? She said, it's proprietary. The way she said proprietary was kind of scary. And I said, that's strange. What if I bought 1,000 shares in your company and then I called you? She said, still be proprietary. I said, I'm part owner of the company. You're refusing to tell me what I own. She thought about it for about 10 seconds. She said, you have a point, but it's still proprietary. At this stage, I'm banging my head against a brick wall. I get ready to hang up the phone. She said, I do have something I can tell you about these cross holdings. Maybe she's going to give me some revenue numbers or operating income. I said, what? She said, I cannot give you specifics, but they're worth a lot. I said, I'm sitting here with an Excel spreadsheet. I'm entering LOT into the cell for cross holdings. Nothing is working below it. Can you put some zeros in the lot? It kind of cuts to the heart of the cross holding culture, right? What do managers do? They hold up a brown paper bag and say, trust me, it's full of cash. I'll tell you how much cash. Can I look in the bag? No, I'll tell you how much. That's exactly what we're letting these companies do. Tell you what the value of the cross holdings is. Why would they ever let you look in the bag? So when I hear emerging market investors complain about companies not telling them much about cross holdings, I said, there's an easy fix to it. Attach a value of 0 to it. You'll be amazed at how quickly the information starts to come out from the companies that have really valuable cross holdings. So in the real world, the problem you often have is you don't have the information and you got to make approximations. So I'll give you what I do. I go to a balance sheet. I see cross holdings on the asset side and minority interest on the liability side. They're both in book value terms. But rather than take the book value and say, that's all I can do, if I know what businesses your cross holdings are, and most of the time I do, I go to my database on what the price to book ratios are for businesses. So let's say you have a chemical cross holding with $100 million book value. And a typical chemical company trades at 1.5 times book value. I take the 100 million times 1.5, come with. Am I happy with this? Not at all. It's sloppy. I wish I could do better. But with the information I have, I take that over book value every single time. So do the best you can with cross holdings. I wish I could tell you that there was an easier way to do it. In fact, with Yahoo, I actually tried pricing the entire company. What does that require? I took each segment and I applied a multiple. I stayed with EV to sales. Why? Because I'm comparing a Japanese company, a Chinese company, US company. Who knows what the accounting variations are? So I went up the income statement. I estimated what multiple of revenues I would expect each of these companies to trade at. We'll talk a little later about how I adjusted the multiples. But basically, I have for Yahoo Japan and Alibaba much higher multiples of revenues, a higher growth, more profitable businesses. I priced those companies. I added up the pricing. Luckily, I got a number very close, but it doesn't have to be. It's a pricing game, and I'm kind of going back to it because I don't have the information. If I hadn't had the information to do an intrinsic valuation. So any questions on cross holdings? So let's talk about what else you might be able to. I've already told you what you can't add on. You can't add on things you've already counted in your cash flows. So you're a hotel company. You value the company as a hotel. You then can't add the value of the hotel as real estate onto the value that you got from your discounted cash flow valuation. So you're looking for truly vacant assets, things you haven't counted. In the 1990s, when the market was booming, equity research analysts used to take overfunded pension plans. So if a pension plan is a defined benefit plan, the money is, the value of the fund is increased, technically the overfunding belongs to equity research analysts, but it's a dangerous game to play, right? Because you can't really extract it without killing labor relations for the rest of eternity. They would count things like that. Or they would say, these are unutilized assets. And you're saying, what exactly is an unutilized asset? So I'll give you an example that's a little off the off the beaten path, but I think it brings home the kinds of things you'd be adding on. Anybody here part of the Michael Price Fund? You're in the Michael Price Fund? Anyone? So this fund, actually, the origin of the fund, does anybody who's in the fund know where the fund was, how the fund got the name Michael Price attached to it? Go ahead, Sue.
Was Michael Price, he wanted to
Who was he? You know?
I forgot something.
He's a rich man, obviously. The question is, how did he get rich? He ran a mutual fund company in the late 90s, the peak of the dot-com boom. He sold his mutual fund company to the Japanese for a couple of $2 billion, which made him a very, very wealthy man. And when NYU notices very wealthy people, you can almost predict what's going to happen next. You get a lot of phone calls telling you the most special person on the face of the earth. They're willing to name things after you. So they asked me whether I'd go ask Michael Price for money. And I said, are you kidding me? I wouldn't give money to NYU. Why would I go ask other people to give money to NYU? I know exactly how much you waste the money. You can't even fix the stupid paper rolls in the bathrooms. My pet peeve. I told them just leave the old-fashioned rolls. They don't break. They wanted to put electronic things. Half of them don't work. That's a different thing. So, but they said, can you please go ask him, because we want this money to start this fund. So I said, okay, one-time exception. I was part of the team that visited Michael, and he gave the money, and the fund got started. And I said, I will have zero official role with this. And it's been going on for 25 years, but off and on, you get people who've gone through this class, go to the fund. The way the fund is structured is you make pitches to the rest of the people on what to buy, what to sell. Once in a while, those pitches find their way into my room. So about 15 years ago, one of the people involved in the fund walks into my office. I never liked this guy. But he walked into his office, he said, I'm facing a conundrum. I very quickly turned to my computer, made sure he wasn't watching, typed in the word conundrum. Turned out he was confused. I said, I like the word. He said, what's your conundrum? He said, I'm valuing Playboy. I said, I don't see a conundrum yet. He said, I valued Playboy and I've come up with 240 million. The stock is trading at 300 million. I still don't see a conundrum. Third time I'd slipped the word in the 5-minute conversation. Don't buy the stock. He said, here's my conundrum. There's one asset that Playboy owns that I haven't counted in the 240 million. You know what he was talking about? It was a Playboy Mansion. The brand name, the bunnies, they're all in the cash flows. The Playboy Mansion was one of the most valuable pieces of property in LA. At that time, estimated to be worth $150 million. It was owned by the company. And you could see the question, should I be counting the 150 million? If you count it, Playboy looks undervalued. I said, technically, yes, but you got one big problem, right? There's an 85-year-old in a bathrobe hanging out in the mansion that you can't exactly evict. Hugh Hefner was still in the mansion. He said, what should I do? I said, check the actuarial tables. What are you checking for? 85-year-olds who surround themselves with 27-year-old playmates. This isn't going to last very long, right? 5 years, the rest is going to be complete. What are you going to do? You're going to take the value of the mansion, discount it back 5 years. You can use a cost to cap for real estate if you want to be fancy. Yeah, I don't think he did it. I don't think they bought it. The pitch didn't go through with the rest of the people on his team. I forgot all about Playboy. A few years later, I opened up the Wall Street Journal. This is a news story. Playboy managed to sell the mansion with Hugh Hefner in it. I'm not kidding. This guy, Darren Metropolis, bought the mansion with the condition that Hugh Hefner would stay there until he died. And they got $200 million. The minute after this happens, think of what happens to Playboy's cash balance, right? It increases by 200 million. This is the kind of asset we're talking about, not brand name, not the stuff you've already counted. And already you can see it's rare. It's uncommon. So when you see lots of stuff added onto a DCF valuation, most of the time people are double counting. But once in a while, you will get this, something you haven't counted because you haven't counted your cash flows. But I want to bring up also, before I finish, I talked about that hotel example. Let's say you value a hotel as a hotel. The Waldorf Astoria, right? Say it valued as a hotel. You might get 300 million for the hotel. You know how much the real estate that the Waldorf is sitting under is worth? Probably $500 million. So here's my question for you. The DCF valuation gives you 300 million. The value of the real estate is $500 million. If you're an investor, which of those two numbers would you use to decide whether to buy shares in the company or not? The 300 million you got from your DCF, the 500 million that you got from the real estate, or something in the middle? If you were acquiring the company, the Waldorf, what did you use, Michael?
Well, you would understand that it's worth 500 million, but you would try to pay 300.
But let's say you get bid up, right? When would you stop?
Well, 500.
So close to, but the minute you buy it, what do you have to do right after?
Then
You'd have to do what they did with the Plaza, right? What did they do with the Plaza Hotel? The people who bought it turned it into apartments instantaneously. So if you're going to do this as an acquirer, you got to carry this through. It's not just how much you pay, it's what you do afterwards. But if you're a passive investor, you can see the problem here, right? If you pay the 500 million that you think the real estate is worth, and the people running the hotel are just emotionally attached to running a hotel, you're going to be stuck with the 300 million. There are textile factories in the middle of Mumbai that are carryovers from 50, 60, 70 years ago. That you look at the land they sit on, they're worth a fraction of the value of the land, but the family that runs them is so attached to the fact that they're a textile family, they continue. So it's not an easy thing to unlock, especially with corporate governance, but you can see this happen. And increasingly around the world, I think especially with hotel companies, this is more the rule than the exception. I can't think of too many hotel companies that are worth more as hotel companies than they are as collections of real estate. And that's a very dangerous place to be if you're a hotel company, because where do you build your next hotel? Where the real estate price will appreciate the most, not where. And this is why Marriott 30 years ago said, this is not going to stand because our hotels are being built by the real estate guys, because they're the ones driving the decision process. What did Marriott do? They took the real estate, they spun it off as a REIT. So now when you invest in Marriott, you get just the hotel management company. They don't own any of the hotels. There's a Marriott REIT that owns the real estate, which I think is far healthier. I think if you're a company that gets so much of your value from real estate, and much of Asia, where real estate prices have soared, I think the best thing you can do often is separate the real estate. There was one period in the US in the early 2000s where real estate prices soared, where companies actually found a way to eat their cake and have it too. What did they do that allowed them to unlock the real estate values while continuing as businesses? Can you sell the real estate and then lease it back? That's exactly what they did. They sold the real estate, they collected the high prices, and because the lease rates didn't keep up with the value of the real estate, you could sell 277 Park and lease it back and pay a fraction. So again, it's the underlying real estate that's causing the distortion. Yes.
How would you go about valuing it, or like what would you do if like there's real estate's used as collateral?
Then you got a loan riding on it, but the bank is not going to complain if you're going to take the real estate and sell it. You're going to pay off the loan. So no bank will ever get in your way. If you want to do that, they're going to encourage you. Say, do it. Let me get my cash out of here. So you're not going to get people stopping you from doing it, because since the value of the real estate is so much more than the value of the underlying property, you face more risk as a bank if it stays a hotel than if they liquidate. Right? I'll predict that as real estate prices have gone up, this is an issue you're going to see more and more rise to the surface when you're looking at these companies. Right? Let's talk about a fourth scenario. Right? We gave the example here. Let's say you're looking at two companies. They look exactly the same in terms of numbers, cash flows, growth rate, tax rate, return on capital. They all look the same. But one company is simple. It's in a single business, has a very simple holding structure. You can see exactly what they own. And its accounting is transparent. What does that mean? They tell you how much money they made, what they own, what they owe, which is what accounting is supposed to do. Company B has exactly the same numbers. It's in multiple businesses, some of which you don't even know what the business is, has a very complex holding structure, special purpose entities, cross holdings, joint ventures. and opaque accounting. What's opaque accounting? You read the financial statements, they claim to be in English, but you have no idea what they're saying. It's in this language called legalese, which vaguely resembles English, but you need 16 lawyers to kind of deconstruct it. It's like watching Enigma over and over again. What's the code? Do I get the code? You got to go to law school, spend 10 years in simple company, complex company. And I started the class with the question, which one would you pay more for? And in a traditional textbook, the answer is they're both worth the same because the numbers are the same. I'll tell you when this became an issue in this class. In the late 90s, there was a company called Tyco. Tyco was a conglomerate that grew through acquisitions, had a gigantic accounting scandal. And the accounting scandal was they'd used the debris from acquisition accounting to hide a lot of bad stuff. What do I mean by debris from acquisition accounting? Items like goodwill and restructuring charges. Turned out they'd hidden a lot of bad stuff. It all blew up. The stock price dropped 70%. But that wasn't the real story in the class. It's the fact that GE lost 15% of its value in parallel. You're saying, what's GE got to do with Tyco? What did I describe Tyco as? A conglomerate that grew through acquisitions. What was GE? A conglomerate that grew through acquisitions. You see why investors' thinking was, right? I got fooled by Tyco. How do I know I'm not being fooled by GE? We're in class and I said, what do you think about this? And everybody in the class agreed that we need to find a way to bring complexity into evaluations because clearly it is hurting what investors are willing to pay. So I said, okay, that's a neat idea. But to do this, you first have to measure complexity, right? You can't just say, I'll know it when I see it. And second, convert that measure of complexity into something in your valuation. Remember the 8 proposition? Cash flows, discount rates, or growth rate. They all agreed. Great idea. And they said, how do we measure complexity? They said, we don't know. That's why you're teaching the class, right? I said, okay, I'll give it a try. I came back the next session, and I have to tell you, they weren't impressed. I counted the number of pages in the 10Q and the 10K. I know it's incredibly simplistic, but if you wanted to avoid one company on this list to value, which one would that be? 1,026 pages to tell me what, this isn't War and Peace. This is how many pages it took them to tell me what happened last year. It takes 1,000 pages to tell me what happened last year. You're one heck of a screwed up company. I put this up. As I said, they weren't impressed. They said, we're not paying. At that point, it was 140,000. Now it's up to 200,000 for an MBA. I don't know what the actual cost is to count pages in a 10K. We want something more sophisticated. I said, I see the point. I'll be back next week. Came back next week, what I call my valuation shit list. It's a technical term. All the things that bug me when I value a company and how much they bug me. I'm capable of converting anything into a spreadsheet number. I remember when my daughter had to pick between colleges, she was incredibly indecisive. So I went through a list of all the things she said. I put weights on it based and came up with a weighted score. Then she threw me off. We visited Tufts and she walked out the 15 minutes and I'm not going to school here. I said, why not? She said, they use 1-ply toilet paper. I said, you never told me this was high up on your list, right? So the problem is it didn't work for my daughter. With complexity though, I thought about things that have bugged me when I value companies, how much they bug me, and come up with a score. So let me give you examples of things that have bugged me through history. A company that claims to be geographically diversified, but doesn't tell you where. So why do you even throw in the geographically diversified? Or they tell you where, but you don't recognize any of the parts of the world they claim to operate in. If a company's effective tax rate goes from 30% to -15 to 22, you know what that tells you, right? There are 2 sets of books, and you're showing me the reporting books, the tax books are very different. So I took the things that bother me, weighted scores, came up with a weighted score, came back to class and said, do you like this more? And they said, this is so much better. This is why we come back for an MBA for. But I said, there's one catch. To come up with this number for Citigroup, what do I need to do? Read 1,026 pages. I said, I'm not in the mood to do that, but each of you is valuing a company, right? They could see the train coming at them down the tracks. Too late to get out of the way now. They said, yes. And I said, this semester, in addition to valuing a company, I'd like you to come up with a complexity score. They bitched and they moaned. But what choice do they have? They should have just stayed with my number of pages. But that semester, I got a complexity score for each of the, I think, 250 people in the class. And I'll give you things that were interesting that came out of those complexity scores. There was zero correlation between company size and complexity. My priors were big companies would be complex, small companies not so. Not the case. There were small companies that were incredibly complex, and much of the complexity was by design. It wasn't accidental. Second, they found that emerging market companies were more complex than developed market companies, primarily because of cross-holdings, not because of accounting structures. Third, they found that any company that grew through acquisitions was about 40% more complex than a company that did not. Some of you are already discovering this the hard way if you're valuing a company that grows through acquisitions. Acquisitions are messy, they're lumpy, they're tough to deal with. And finally, they found that any company with a financing arm was significantly more complex, 50% more so than company without. What am I talking about? Financing arm.
Like Ford Motor Company.
Ford Capital, Volkswagen. Why? Because you got a captive bank. It's not a regular bank, right? It's a captive bank. Captive bank, why? Because almost all of their financing is for people buying Ford cars. Often they're the ones through which you deliver the discounts to get people to buy. So it's a very strange bank with a lot of debt. And the company says, trust us. There's a Chinese wall around the bank. I have no idea whether there's actually a Chinese wall. They also found that accounting in general had made things more complex over time. Every time accounting rule writers add a rule, it adds to the complexity. I know they're well-intentioned, but it's adding to complexity. So once you measure complexity, the question is, where do I put it? I'll give you the choices. In good times, you just ignore it. The 1990s, nobody cared about complexity, the dot-com boom. It's only when things get a little dangerous, risky, that you start thinking about complexity. In the next few months, you're going to see all those hidden flaws in a Palantir or one of the young tech companies come to the surface, because all you need is the market price to go down 20% and people start noticing. It's like being the coach of a team. Notice when you're winning, nobody points out the fact that your calls are all wrong. You just happened to win because you got lucky. The minute you start losing, oh my God, this guy's a terrible coach. So how did that happen overnight? So in good times, but in bad times, you got to find a place to put it. And here are the choices. You can take your cash flows and haircut them. What is haircutting them? In a complex company, you knock off 3, 5, 10%. People call these conservative estimates, but effectively that's what you're doing. I don't like it because it's completely arbitrary. The second is you can use a higher discount rate for complex firms. And here I can offer you a way there. I told you I spent a month on complexity. And one of the things I did, I took the S&P 500 and I split it down the middle into 250 simpler and 250 more complex companies. Subjective judgment, but I threw them into two piles. And then I computed the implied cost of equity. Remember how we did the implied equity risk premium for each group? The complex companies had an implied cost of equity about 1% higher than the simpler companies. And that extra 1% becomes an extra, so you push up the discount rate. But I'll give you my favorite way of dealing with complexity. You know what drives value, right? Whether you can earn more than your cost of capital. And when we did that, we talked about what might cause a company to earn more than its cost of capital, which is competitive advantages, barriers to entry, which if you understand what a business does, you can list for me. So if I ask you, what are the competitive advantages of Apple? Or what are the competitive advantages of Pfizer? It's a pretty simple list to go through. But if you're looking at a company where you're not sure what it does, it makes a lot of money. How the heck can you tell me that they can keep doing what they're doing if you have no idea what they're doing in the first place? In the late 90s, one of the companies that would repeatedly show up in this class as a company being valued was Enron. That time, $70 billion market cap company, considered a superstar. This is before the accounting scandals and all of the fiascos that followed. To a person, every person who picked Enron would come into my office and say, I know they're making a lot of money, but I don't know what they do. What was Enron? What did they do? Energy trader. What the heck does that even mean? Who are you buying the energy from? Who are you selling it to? Why are you able to make the difference? And why doesn't other, so it was kind of a fuzzy business. On top of that, they also had all these special purpose entities that were incredibly profitable, but nobody had any idea what they did. So they said, I don't know what Enron does. And my response was not that there was an accounting scandal. I didn't know that. I said, if you don't know what they do, then don't assume they can earn more than their cost of capital for other than a very short time period. Close the gap. If you close the gap, the minute you did that, half of Enron's value disappeared. Enron always looked overvalued once you close the gap. If you're valuing a business where you're unclear how the company makes money, it's very dangerous to assume they can keep doing this for the next 10 years and earn well above their cost of capital. The final piece of this monthly pursuit of complexity, I decided to run a regression. I took the 100 largest market cap companies in the US, ran a regression against return equity, beta, and growth rate, which are conventional variables. We'll talk about why they show up when you look at price to book later in the class. But I threw in the number of pages in the 10K into the regression. To help me out here, what's this minus 0.003 telling me about price to book? Diksha? No, don't. The coefficient doesn't tell you that, right? That's the t-statistic standard error, right? The coefficient just is a function of the number of units on your dependent variable. So large coefficients are not better than small ones because it depends on what you're multiplying by. Okay? So if you take that and that was it's statistically significant, minus 0.003. What does it mean? Every 100 pages in your 10K suit finished off, what happens?
Basically, every 1,000 page your price, your valuation goes down.
Let's make it 100. 100 already pushes you to 0.3, right? So lowers your price to book ratio about 0.3. So if you're Citigroup and your price to book ratio is 0.9, which it was then, I have a very simple proposal for you to double your price to book. What should you do? Knock 300 pages off your 10K. Sounds incredibly facetious, but he's saying simplify. I am convinced that money center banks now face a problem. Since 2008, investors have lost faith in being able to break them up. They now, every money center bank CEO complains about, given their return equity, why aren't they trading at price to book ratios that they did before? Because that complexity, I mean, do you really feel comfortable when you invest in JP Morgan that you know where they make money and how they, I don't. So what's the fix? What if Jamie Dimon were in here and he said, what should I do? What's the logical fix? The fact that JP Morgan has become this incredibly complicated beast and nobody's quite sure what to do. Can they trade as independent pieces? You could have JP Morgan Bank, JP Morgan Investment Bank, JP Morgan Trading. I think they'd be worth more as the sum of their pieces. And I would say the same thing about many of the money center banks than they are as, there's no synergistic effect. In fact, I'm going to argue that having a bank and investment bank is actually hurting them because of the rules being imposed on banking kind of spreading over. Will Jamie Dimon do this? Not in this lifetime. He likes being the emperor of the largest bank in the world. And then the same advice would apply to Citigroup, a bank that is in serious trouble. You say, why? Because I think the complexity is becoming a huge obstacle to investors saying, I trust that bank and how it makes money. So at this stage, what do we have? We have the cash flows, we've dealt with cash, we've dealt with cross holdings, other assets, we've kind of dealt with complexity. Now we get to the point of subtracting our debt. The rule is debt should include all contractual obligations, interest-bearing debt, leases. And when we do cost of capital, that's where we stop, right? And with cost of capital, I said, be restrictive in your definition of debt. Don't start to bring everything into debt, because if you do, you'll inflate the debt number, lower your cost of capital. So with the cost of capital, the rule is be conservative. Count only those things that are interest-bearing and contractual. But let's say you use that, come up with the cost of capital. You value the business, and then you say, what should I subtract out? Things get messier. And let's talk about what. Let's suppose that you take the free cash flow firm for a telecom company. It's a distressed telecom company. Okay? And you come up with $1 billion in the value for the operating assets. Let's say this company has $1 billion in book value of debt, but because it's distressed, that debt is trading at half of book value. How much would you pay for the equity in this company? You see the choice I'm asking, right? Would you subtract out the $1 billion in book value, in which case the equity is worth nothing? or would you subtract out the market value of debt? It's one of the trickiest questions. I go back and forth on this. The rule in every valuation book is, right? What should you subtract out? Market value of debt, in which case you pay 500 million for the equity. But why is the value of equity 500 million? Because people think the company is distressed. If you're an acquirer and you paid the 500 million, you be making a serious mistake, because the minute you buy the company, what will happen to the distress factor? It's going to disappear. So this is one of those cases where, depending on whether you're valuing it as a passive investor expecting the 500 million to reflect where the company is today, or whether you're doing it for a liquidation valuation, you're going to use different answers. If it's a passive investor, you might be able to get away with the 500 million and hope that time and health kind of come over and you benefit from both. But if you're doing a liquidation, don't subtract out the market value of debt. You subtract out the book value of debt. The bank is not going to take half of what you owe them if they know you've collected 1.2 billion. So when you do debt, traditional rule is market value. With distressed companies, you might want to kind of step back. And we'll come back to distressed companies and talk more about the valuation. One final point. You've subtracted the debt that's on the balance sheet. You brought in the leases. But then you look around and say, is there something else? Remember, this is your last chance to deal with any of the things that worry you as an equity investor. And this is where pension plans and lawsuits can come into play. I don't know whether you're familiar with how pension plans in the US are structured. They can either be defined contribution plans or defined benefit plans. What's the difference? Defined contribution, defined benefit. Michael?
Yeah, defined contributions like your 401k,
Yep.
whereas defined benefit is the pension, which doesn't exist too much anymore.
In the last century, many US companies had defined pension plans. Disney, until 2012, my son actually joined Disney in 2011. He got lucky enough to be grandfathered in. The last generation getting a defined benefit plan. But defined benefits plans used to be the dominant version of pension plans at US companies. You're saying, so what? In a defined benefit plan, I promise you $1,000 a month after you retire. Then what do? I invest in stocks and bonds and financial assets to make sure I have enough money to pay. So at the end of every year, these companies are supposed to estimate what they own liabilities and what the value of their assets is, leading a fund to be either overfunded or underfunded. Overfunded plans, we talked about, are plans where the value of the assets is greater than the present value of your liabilities, but underfunded plans have a deficit. So let's say you're investing in a company with an underfunded plan. You're saying, shouldn't that be in my debt? No, because underfunding is not something you have to show on your books in the US yet. In other countries, that's not true. If you're in Germany, underfunding shows up in the balance sheet. Here, it's off balance sheet. But should that worry you? Yeah. You either deal with it as debt, or what's the other way of bringing in the fact that you have an underfunded plan? What does this company have to do in future years to make the underfunding go away? It needs to set aside more. So you have to set a sinking fund that reduces your cash flows in future years. So underfunding, if it's there, has to be dealt with because it affects the value of your equity. The other issues I talked about is if you're the target of a lawsuit. And if you're in the US, who isn't? Right? Will it affect your value? Depends on whether it cuts to the heart of your existence. Now, in one of the worst acquisitions of all time, about a decade ago, and this is a tough contest to win, this German company, chemical company called Bayer, bought Monsanto. And I remember looking and saying, what's wrong with you guys? They gave some cockamamie story about consolidating the animal feed business. That was their strategic reason. But when Bayer bought Monsanto, they also bought themselves a heap of trouble. In what form?
They were doing the GMOs, so
Not even, it's Roundup. Basically, every lawn in the US is so green. Part of the reason it's so green is because you're using Roundup. And Roundup, over time, has created a whole host of cancer cases. So those cases were already navigating their way through the court system. There was nothing on the balance sheet yet. But Bayer couldn't claim ignorance of this. Everybody knew this. But I'm sure there's a banker who came in and did the cash flows, discount back, came up with the value of the firm, subtract that. So this looks like a bargain. And right after Bayer bought Monsanto, what happens to the bargain? It becomes a nightmare. If you have lawsuits hanging over your head, this is your last chance to deal with them. There might only be a 5% chance you could lose the lawsuit, but if it's going to cost you $2 billion, you take the expected value. Are there any law students in this class? Okay. My corporate finance, oh, there. Here's a niche business for you in investing, right? Pick companies that are targeted in lawsuits because the market has zero idea how to deal with these companies. I saw this with Merck and Vioxx, right? You go from ecstasy to agony to ecstasy to agony based on whatever the last.
Oh, yeah, because I worked for the law firm.
Yeah. And I think there's a niche market here. There's an entire group of companies like Bayer where you can argue that if you can bring in, because this has nothing to do with finance. I have no idea how the legal system works with the appeals process, what you end up paying. That could be a competitive edge around which you invest, is picking companies in the heart of the storm and saying, I am in better position to assess what this will play out as. But that's your last job. Let's do one final thing, and I'll set up at least, and this will be for the next class. As I said, over the last few decades, increasingly US companies have turned to using equity. There's good reasons for that. What are some of the reasons why a company might grant equity to its employees? Yeah, go ahead, Ned.
You don't have to use cash.
One is if you're cash poor, this allows you. What else?
Keeps them invested, you are able to.
There's an incentive thing. Now they want to, at least in theory, think like shareholders. So there are good reasons for using equity. So I have no problem with it, but it does create a cost. Don't tell me it's costless and free because that makes no sense. And there are two forms that equity compensation can take. One is in the 1990s, 90% of the equity compensation in the US took the form of options. Today, 90% take the form of restricted stock. We'll talk about what caused that shift. It was an accounting change in how options were expensed that made the difference. But next class, we're going to talk about how employee compensation affects cash flows and value and how to bring it into the process. So I will see you on Wednesday.
It's like super slow, but this is so-
Right, like the guy that he's gonna win, and when. Oh, yeah, sure. Yeah.
Well enough on the other collisions when the first one gets brought up. Right now, it's kind of filled in like the wrong, I had the right answer, I filled in the wrong answer for like question 3. On the cash flow question, I read the wrong assumption. You said like EBIT margin of like 20 or something, but I used I lost a lot of marks. Okay.
Yeah, it's the best one. Tuesday, it's, so I get there from 10, I mean, 10:30 to 12, then I go to the stretch conference. Do you want to try to do? Are you done? I'm doing my thing. You did all the first part when you.
My buddy on.
Meeting has.
I learned more about this goals and I need to like make a whole version of that space. And I'd be interested in that position too, so. And like, yeah, literally, there's gonna be multiple versions of me on paper.
I feel like this, I have that one too.
Do you like my sales resume better? Right.
Yeah.
Different false identities, so.
That's something to roll.
No, yeah, it's.
C3, that's like kind of the only thing they have.
There's still time. Don't run away. Disappear.
It's, they say it's more on the client side, it's like, I think it's like.
I'll never know.
Yeah, there's this, that was on the panel, I think.
Yeah.
Yeah, he was last year Tech MBA, has that position. I hear it's better than people. I'll hear back this week, then, but it's like, still. It's very demanding, but it's not as risky as. what I do.
Yeah. She's not responding.
I mean. I'd say. Like, you don't even need a. Actually, I have an email of somebody. Yeah. I could send you an email of this guy.
Why don't you get the job this week and refer me?
You can turn this into a cat.
Let's negotiate, but I need to refer my.
Can I get the referral bonus?